quick market update. The market has continued to trade downwards, especially when it comes to growth stocks. This really isn't anything new based on the conversations we had about the 10-year Treasury, expectations on interest rates. When interest rates go higher, we also expect oil to move higher, reopening trades to come to fruition. What are reopening trades? Things like the gap, which is actually surprisingly held up well here. Alternatively, things like Lululemon, that's more of a stay-at-home stock, even though they're both retail trades. And by retail, I mean mall-based. They kind of cater to a different market. Obviously, gasoline prices, surging demand, that's really related to demand for gasoline. Gas prices are higher now compared to last year. Not really related to politics, more so related to more people are driving, more people are taking vacations this year. So that's certainly a function of the environment. Central banks continue to be out there saying that they're going to keep rates low, while rates that are more market-based, based on investor psychology, have been trading up. So that's a huge controversy in the market right now. A lot of old school investors are concerned about inflation. In my opinion, the impact and trade-off of technology prevent a lot of the inflation people are worried about. That should mean, buying growth stocks into weakness. Why? Because if we don't get a lot of inflation, that means the Fed isn't really inclined to raise rates. And the long end of the curve that's determined by the market, the 10-year Treasury, should kind of settle down a bit. What we saw today was a little bit of bloodbath in tech. Continue to see kind of bad numbers, and by bad numbers I mean performance, from names that are associated with growth. This also includes assets like Bitcoin, right? Also today, General Mills reported a good earnings report, not as hot as the market expected. They reported 82 cents a share versus what the market expected of 84 cents. This is also a concern around, hey, you know what? Once the economy reopens more broadly, you're going to have less Cinnamon Toast Crunch and more Egg McMuffins and Dunkin' Donuts. Now, is that really going to be true? Some of the stuff we've seen in Florida this week is really a reminder that the path to reopening is not going to be a smooth line upward and forward. It's going to be full of fits and starts. Can you imagine how many people had planned a trip to Miami in the next 4 to 6 weeks who now may be second guessing or replanning their trip or replanning a vacation at all? Because who wants to walk into something like that? I just think it's not going to be a straight line to reopening. You even saw the CDC today roll back cruise operations until November, which, why not just make it next spring at that point if you're not going to have it till November? I am being a little facetious. Why are they saying November? Even though we'll be close to the winter season, which we associate with the flu, even though it doesn't really have a lot of correlation with COVID. We expect most people to be broadly vaccinated by then, and they're just taking a more conservative approach on the regulatory side. So, when will we see the kind of end of the route we're seeing in growth stocks right now? Could be a couple weeks, could be a couple months. If you look back at 2015 and 2016, there was a similar function of what we're seeing right now. Let me see if I can pull that up for you guys. And how does this change from the perspective of your wealth, right? Well, guess what? You have less money in your retirement accounts. You're going to feel, less wealthy, right? Why? Well, because, your balances are less. Let me show you this right here. I'll pivot to this screen for you. This is a Russell 1000 Growth Index today, one-day number, down 0.7%. But if we go back, max it out, Let's go back a little bit further. Now, it's hard to see here, but from the summer of 2015, you can see that the growth index was 102 at about a high. And then by the bottom, around the beginning of January 2016, it had dropped about 10%, right? That was a pretty significant dip for what we'd call like a non-economic event, right? You saw probably over a 10% correction from the high in the large cap growth, probably closer to 15% from the bottom. Why? Because interest rates were projected to go higher in 2016. What happened is the Fed stopped the quantitative easing. Now you've seen some other large dips. We saw in 2018 to 2019, there was a huge growth route, also driven by interest rates, 155 to 130. That's probably another, again, 10 to 15% correction based on effectively a non-event. COVID, a little bit different there, right? Because that correction was really driven by an event. Similar with 2007, 2008, right? We saw, growth almost get cut in half, similar to what we saw in COVID. But those were real economic events. These are kind of more along the lines of interest rate corrections. These interest rate corrections were probably feels like close to the bottom here. When you talk about max capitulation, when do people like throw up their hands and say they've given up? Are we at that point yet? It feels like it, but it remains to be seen. Interest rates need to stabilize. People need to get less concerned about that. But there's still a lot of uncertainty in the economy. And when there's a lot of uncertainty, we'll continue to see volatility. But I hope everyone's having a great week and looking forward to seeing everyone soon.